called Pankaj Ahuja of Panipat was a supervisor in a factory. When his factory was closed during the second wave of coronavirus, he started a small business. Now he is wondering what to do with the money lying in his Provident Fund account. Will he be able to withdraw money every year from this account for survival? Will he continue to earn interest like before? Will he also have to pay taxes if he continues to receive interest? He is confused. Let us understand in this special show of Red Alert what do the income tax rules say on PF withdrawal and what should Pankaj do. PF accounts have been divided in two categories. First, active account and second, inactive. The account in which the contribution is deposited regularly come under the active category, while the accounts in which no deposit has been made for 36 months are considered to be inactive. Annual interest is earned regularly on active accounts. Interest will continue to accrue on the dormant account till the employee reaches the age of retirement. In the year 2011, EPFO stopped paying interest on dormant accounts, but it was started again in 2016. If the account is inactive and the account holder reaches the age of 58, then he will stop getting interest on PF account. Similarly, if that person has retired and has not withdrawn PF money, then the interest earned on this amount will come under the purview of income tax. Because tax exemption on PF interest has been ensured only for employees. According to the rules, if the person has become unemployed, then he is not considered as an employee. Tax and investment expert Balwant Jain says that Provident Fund is a retirement plan which gives the highest amount of interest. Unless there is a dire need of money, it should not be withdrawn. Mr. Jain explains that after retirement, a person will keep earning interest on the PF account. But this income earned will be taxable. Tax has to be paid on this amount on the basis of tax slab. If an employee completes 5 years of services in a company and after that he withdraws money from PF, then no tax liability occurs. This 5-year period can comprise of time spent in one company or in more than one company taken together. It is not necessary that 5 years of services is required in the same company. If the withdrawal is made before the completion of 5 years, then the amount will be added to the annual income and the total income will be taxed on the basis of his tax slab. It is seen many times that an employee is unable to do a job due to poor health. In some cases, the job is lost because the organization shuts down suddenly. In such a situation, if the period of 5 years of service is not completed, then the amount of PF withdrawal will not come under the tax purview. If a situation arises which is not under the control of the employee, then there will be no tax levied amount withdrawn from PF account. If after losing the job, the person starts working in another institution, the PF of the old company can be transferred to the PF account of the new company. In such a situation, there will be no tax liability on the PF contribution. Under the existing rules, the universal account number UAN of the employee remains the same while the PF accounts in different companies are different. If an employee transfers the entire PF amount to his NPS account, then there will be no income tax liability on this amount. It is to be noted that the income earned till the date on which the job was lost will not be taxable. The interest income earned after the termination of the job will be treated as taxable. It has to be shown as income from other sources in the income tax return, that is ITR. Now the question is whether Pankaj can withdraw money every year from PF account for his personal needs. Under the rules of the Employees Provident Fund organization, if the job of an employee is terminated, then the entire amount accumulated in his PF account can be withdrawn in a lump sum. However, under certain circumstances, partial withdrawals can be made as advances. For example, during the corona pandemic, an amount equal to 3 months basic salary and DA was allowed to be withdrawn if the person was unemployed for more than a month. Money9 suggests, before withdrawing money from PF account, one must first understand the importance of this fund. This amount should be only used in the long run. If any member of the family is ill and he can't arrange money for his treatment, then only he should withdraw from PF. Similarly, if you have bought an expensive loan and you are finding it difficult to pay its EMI, then you can use the amount of PF account. There is no sense in withdrawing money from this fund and investing it elsewhere in the greed of higher returns. Do not use this fund to follow your hobbies or other recreation purposes. Use this account only if you have no other option.